Asterisk asterisk. In October 2001, Enron Corporation was the seventh largest company in America, valued at over $70 billion. Just 2 months later, it filed for the largest bankruptcy in United States history. This is the story of how corporate greed, accounting fraud, and regulatory failure combined to create one of the most spectacular business collapses ever witnessed. Enron began in 1985 when Kenneth Lay merged two natural gas pipeline companies. Initially, it was a straightforward energy company, transporting natural gas through pipelines across America, but Lay had bigger ambitions. When the energy market was deregulated in the 1990s, Enron transformed from a simple pipeline operator into an energy trading powerhouse. Jeffrey Skilling joined Enron in 1990 and became the architect of its radical transformation. Skilling, a former McKinsey consultant, convinced Lay to adopt an asset-light business model. Instead of just owning pipelines and power plants, Enron would create markets where energy could be traded like stocks or commodities. The company hired the best and brightest from top business schools, creating a culture of aggressive risk-taking and relentless profit pursuit. By the late 1990s, Enron wasn't just trading energy. The company had expanded into water rights, advertising time, internet bandwidth, and even weather derivatives. Wall Street loved it. Enron's stock price soared from $5 in 1990 to over $90 by mid-2000. Fortune magazine named Enron America's most innovative company for 6 consecutive years. But beneath the glossy exterior, something sinister was brewing. Enron's profits were largely an illusion created through accounting tricks that would eventually be its downfall. The company used a technique called mark-to-market accounting, which allowed them to book projected future profits from long-term contracts immediately, even before any actual cash changed hands. Here's how it worked. If Enron signed a 30-year energy supply contract, they could estimate all the profits they expected to make over those 3 decades and record them as revenue immediately. If reality didn't match their optimistic projections, there was no mechanism to correct the books until much later. This created tremendous pressure to continually sign new deals and inflate profit expectations to maintain the appearance of growth. Even more troubling were the special purpose entities, or SPEs. Chief Financial Officer Andrew Fastow created thousands of these off-balance sheet partnerships with names like Chuco, LJM, and Raptor. Officially, these entities were designed to hedge risk and manage assets. In reality, they served a darker purpose, hiding Enron's mounting debts and losses from investors and regulators. Fastow used these partnerships to conduct deals with Enron itself, often personally profiting from both sides of transactions. Enron would sell underperforming assets to these SPEs at inflated prices, booking immediate gains while the losses disappeared into off-balance sheet entities. When those entities needed capital, Enron would guarantee them with its own stock, creating a house of cards that depended entirely on Enron's share price remaining high. The company's culture reinforced this deception. Enron used a rank-and-yank employee evaluation system where the bottom 15% of performers were fired every year. This created intense internal competition and discouraged anyone from questioning dubious practices. Employees who raised concerns were marginalized or terminated. The message was clear. Deliver results, no matter how, or get out. By 2001, cracks began appearing in the facade. Several analysts started questioning Enron's financial statements, which had become impossibly complex. Bethany McLean, a Fortune reporter, published an article in March 2001 asking a simple question. How exactly does Enron make its money? The company's response was dismissive and defensive, with Skilling infamously calling one skeptical analyst an inappropriate name during a conference call. In August 2001, Jeffrey Skilling abruptly resigned as CEO after only 6 months in the position, citing personal reasons. Kenneth Lay resumed the CEO role, but his reassurances did little to calm growing anxiety. Shortly after, Sharon Watkins, an Enron vice president, sent an anonymous memo to Lay warning that the company might implode in a wave of accounting scandals. On October 16, 2001, Enron announced a $618 million loss for the third quarter and revealed it was reducing shareholder equity by $1.2 billion related to the SPEs. The Securities and Exchange Commission launched an investigation. Enron's stock, which had been trading above $80 per share just a year earlier, began a death spiral. As investigators dug deeper, the full extent of the fraud became apparent. Enron had hidden billions in debt, inflated revenues, and manipulated financial statements for years. In November, Enron restated its earnings going back to 1997, wiping out nearly $600 million in previously reported profits. Trading partners lost confidence, and the company's energy trading business, its core operation, essentially shut down overnight. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection, listing $63 billion in assets. It was the largest bankruptcy in American history at that time. 20,000 employees lost their jobs. Many also lost their retirement savings, which had been heavily invested in Enron stock that became worthless. Meanwhile, executives had sold hundreds of millions of dollars in shares before the collapse. The criminal prosecutions came next. Andrew Fastow pleaded guilty to conspiracy and served 6 years in prison. Jeffrey Skilling was convicted of fraud and insider trading, receiving a 24-year sentence, later reduced to 14 years. Kenneth Lay was also convicted on multiple counts, but died of a heart attack before sentencing, resulting in his conviction being vacated. Arthur Andersen, one of the world's largest accounting firms and Enron's auditor, was convicted of obstruction of justice for shredding documents related to the Enron audit. Though this conviction was later overturned, the firm's reputation was destroyed, and it collapsed, putting 85,000 people out of work worldwide. The Enron scandal prompted massive regulatory reform. Congress passed the Sarbanes-Oxley Act in 2002, implementing stricter oversight of corporate accounting practices, greater penalties for financial fraud, and enhanced protection for whistleblowers. Chief executives and financial officers now face personal criminal liability for financial misstatements. The lessons from Enron remain relevant today. The scandal revealed how perverse incentives, inadequate oversight, and a culture prioritizing short-term stock price over sustainable business practices can corrupt even highly educated professionals. It showed that complexity in financial statements often hides rather than reveals truth, and that independent verification of corporate claims is essential. Enron's story is ultimately one of human weakness amplified by systemic failure. Smart people convinced themselves that the rules didn't apply to them, that innovation justified deception, and that short-term success excused long-term consequences. They were wrong, and the price was paid by thousands of innocent employees and investors who trusted that America's 7th largest company was actually what it appeared to be. Today, the Enron scandal stands as a permanent reminder that in business, as in life, there are no shortcuts to legitimate success. The building that once bore Enron's name in Houston now belongs to others, but the lessons from what happened inside those walls continue to echo through corporate boardrooms and regulatory agencies worldwide. $74 billion in market value evaporated, not because of market forces or competition, but because the foundation was built on lies.